Welcome to our video about VAT, the value-added tax, in an international context. In this video we show you all you need to know. How does the VAT system work? How to apply VAT rules in an international context for goods and for services. Here, we also show how invoices must be issued. Please note, in the EU, the European VAT directive constitutes a framework, but there are differences on national level. Generally, the VAT is paid by the consumer to the state in an indirect way. The business sector must collect and forward it to the state. Let us look at 3 examples in a country where there is a 20% VAT rate. Situation 1, the easiest case. The consumer buys a service at a supplier, let us assume at a retailer, for example the repair of a product without warranty. He pays a net price of €100 plus the VAT of €20, in total €120. This supplier then declares €20 in his VAT declaration and pays €20 to the tax office. Situation 2, similar, but the supplier purchases goods from another supplier. The supplier, we call him now supplier 1, purchases the goods from a supplier 2. Let us assume a wholesaler, at €50 plus €10 VAT. The supplier 1 declares the €20 in his VAT declaration and deducts the €10 which he had paid to the supplier 2. He pays €10 to the tax office. The supplier 2 declares €10 in his VAT declaration and also pays €10 to the tax office. In total, €20 end up at the tax office. Situation 3, the supplier 2 acts as importer and purchases goods from a foreign supplier, we call him supplier 3. The countries prefer to collect VAT in their own territory. Every importer is obliged to collect the VAT on behalf of the foreign supplier. Let us assume in our example, the foreign supplier 3 sells the goods to the importer, supplier 2 for €25. The cross-border invoice is issued without VAT and has the reverse charge clause. Supplier 2 declares first the €10 in his VAT declaration which he had received from supplier 1. In addition, he declares like a trustee the €5 on behalf of supplier 3 and deducts this €5 as his own input tax. He pays €10 to the tax office. In total, the €20 which the consumer had paid end up at the tax office. So this is the system, and now we move on how to apply VAT rules in an international context. Well, please be aware that documentation is just a description of the reality. I will first explain the standard situations, after this some special rules, and at our website you can find some more details and examples. To begin, we need to answer 2 basic questions. First, is the situation business to business or business to consumer? Second, does the transaction happen within a country, cross-border within the EU or cross-border with a partner outside the EU? There are special rules about the place of supply for VAT purposes. If the transaction is B2C, then as a basic rule, the VAT is charged and paid where the supplier is located. For electronic services and mail order, there are some special rules which we will see later. If the transaction is B2B, we need to define where it happens and issue the invoice properly based on the rules for the place of supply. If a transaction happens within a country, only national VAT applies. If a transaction happens cross-border within the EU, then the invoice must be issued without VAT and the reverse charge clause. Both VAT numbers need to be written on the invoice, and the recipient needs to check the VAT number of the supplier in the VIS system. If B2B sales happen cross-border to a partner outside the EU, then the EU supplier needs to collect evidence that the customer is an entrepreneur. Now what are the rules for the place of supply? There is a difference between the place of supply for goods and for services. Let us first look at the supply of goods. Here, the movement of the goods is relevant, and there is always a starting point and a destination point. If goods are moving locally within a country, the local VAT of the country applies, both for B2B and for B2C. If goods move cross-border for B2C, then the local VAT applies, as long as thresholds are not exceeded. If goods move cross-border for B2B, then the invoice is issued without VAT and with reverse charge clause. For the supply of services, the default rule assumes that the place of supply is in the country where the recipient is located, even if the services are performed somewhere else. There is a different place of supply in the following cases. For real estate transactions, it is where the real estate is located. For transport services, the place of supply is defined where the transport starts. For some services, like hotels, restaurants, conferences or physical medical services, the place of supply is defined where the service actually happens. Now there are a few special cases. Case 1, triangle transaction, an intermediary buys and sells goods, but the goods are sent from the supplier directly to the customer. If there are 3 EU member states involved and all 3 international VAT numbers are registered, it is possible that the supplier invoices to the intermediary and the intermediary invoices to the final customer. Case 2, a chain transaction. This is a transport of goods directly from the first supplier to the final customer, with several steps between the supplier and the customer. Here it is defined that just one single transaction can qualify as tax-free intra-community transaction. For example, goods shall be transported from supplier A to the customer E, but there are supplier B, supplier C and supplier D in the chain, and all are in different EU member states. Now the rules allow that one supplier in the chain acts as an intermediary who makes or organizes the transport. This intermediary shall have a VAT number in the country of supplier A. Let us assume B is the intermediary. Then the first supply from A to B is a domestic supply, a sells to B in country A with VAT. The next supply is a zero-rated cross-border supply organized by B with his VAT number in country A and the VAT number of C in country E. Supplier C then makes a domestic supply to D in country E with VAT and D makes a domestic supply to the final customer E in country E with VAT. As next point in our video, we discuss some special rules for B2C in the EU. As mentioned before, there are also special rules for B2C sales of goods with low annual turnovers to a destination country, for example less than €10,000 in the current and the preceding year. To have reduced bureaucratic burden, the suppliers are allowed to charge VAT to their customers at the rate of their own country, declare and pay it there. For B2C digital services above this threshold in the EU, MOS, the mini one-stop shop is available. It allows to submit the VAT declaration for multiple EU countries in just one EU country, without registering in the destination countries. For importers of goods with a sales value of less than €150, the IOSS system is available. IOSS means Import One-Stop Shop. If an interface is used to sell these goods, the entity with this interface is considered to be tax subject. The VAT for all such sales to buyers within the EU can be registered in one platform at one member state. For the sales, the tax rate of each destination country has to be applied. Suppliers that are not based in the EU normally need to appoint a tax representative in the EU to fulfill their VAT obligations under IOSS. Thank you for watching this video. If you did it because you want to act legally, but increase profits and save tax, do not wait, but contact us on our website, Zugimpex.com.